All right. Well, great. We'll get started then. Hi, everybody, and welcome to today's webinar on behalf of the Jacobs Levy Equity Management Center for Quantitative Financial Research at Wharton. I'm Chris Geczy, Academic Director of the Jacobs Levy Center, along with Craig McKinley and Managing Director Lauren Hurry. Today's webinar focuses on CLO performance and is an exploration of a center working paper of the same name. It's co-authored by Michael Roberts, the William H. Lawrence Professor and Professor of Finance at the Wharton School, who is with us today, along with Larry Cordell of the Federal Reserve Bank of Philadelphia and Michael Schwert, also of Wharton. John Griffin, the James A. Elkin Centennial Chair of Finance at the McCombs School of Business at UT Austin, also joins us today as a discussant. Michael and John, welcome. It's great to see you guys, and thanks for being with us. We're eager to move right into the research, but first a few words about the center. I'd like to take the opportunity to thank Bruce Jacobs and Ken Levy, whose gifts to Wharton starting in 2011 and whose ongoing partnership not only helped establish the Jacobs Levy Equity Management Center for Quantitative Financial Research and the Wharton Jacobs Levy Prize for Quantitative Financial Innovation, but have helped grow the center and seen it flourish. The gifts were made to commemorate the 25th anniversary of their firm, Jacobs Levy Equity Management, which they co-founded in 1986. Since then, Bruce and Ken have played a major role in bringing quant investing to the forefront, publishing a well-known series of significant articles in leading professional journals, co-authoring well-regarded books, and generously supporting scholarship in finance and helping support our school's role as a leader in research and scholarship in the field of quantitative finance. The Jacobs Levy Center awards doctoral fellowships and research grants to the aid of faculty and student projects. We also maintain a center working paper series, of which today's paper is a part, and which is available on our SSRN feed, in addition to the center's website. Every year, the most exceptional submissions to the working paper series are recognized with the Jacobs Levy Center Research Paper Prizes. Included among those is today's paper, which received our 2020 prize for best paper. It studies the performance of CLOs, collateralized loan obligations, which bundle and sell corporate debt to investors, as many of you know. CLOs have certainly been much discussed, although relatively little empirical research has emerged in academics anyway. And it's estimated that more than $100 billion of these investments are currently owned by banks. Some have raised alarms that they bear similarities to the CDOs that played a role in the 2008 financial crisis. Some say 2006, some say 2007, echoing a worry that another crash may be looming. However, the authors of our paper today contend that concerns over the impact of CLOs on the financial system are indeed misplaced. Michael and also Michael Roberts and Schwert detailed their reasoning in a recent opinion piece for Knowledge at Wharton. We'll share the link in the chat, and please, I encourage all of you to check it out after today's presentation. The CLO performance paper delves more deeply into that topic, addressing two main questions. First, what market imperfections are CLOs designed to address? And how large are the economic costs of these imperfections? The authors test the implications of different imperfections for the performance of CLO assets and liabilities. They also provide large sample evidence on CLO performance, highlighting the risks and reward of these vehicles using data not heretofore seen. I'm going to shortly hand it off to Michael to start, but briefly a bit more about our presenters, whom I think most of you know, but I think it's more than appropriate to let you know if you don't. Michael Roberts is the William H. Lawrence Professor of Finance at the Wharton School, as I mentioned. His research spans corporate finance, banking, and asset pricing, and has received numerous awards, including 2 Brattle Prizes for distinguished papers published in the Journal of Finance, a Jensen Prize for the best paper on corporate finance and organizations published in the JFE, and best paper awards for the annual meetings of the Financial Management Association and Southwestern Finance Association. He served on numerous journal editorial boards, including the Journal of Finance, of which he was a co-editor. Michael has also won multiple teaching awards, instructing undergraduates, MBAs, PhDs, and executives. In addition to Wharton, he's taught at the Fuqua School, at Duke, and UC Berkeley. John Griffin is the James Elkin Centennial Chair in Finance at the McCombs School of Business at UT Austin. His research focuses on understanding the role of conflicts of interest and misreporting played in the financial crisis, among other topics. His expertise includes structured finance, credit ratings, international finance, and institutional investments, with topics of papers covering a broad range from the financial crisis, manipulation, mortgage misreporting, credit ratings, insider trading, investment banking, cryptocurrencies, corruption, trading behavior, international finance. And I can think of a couple of those things that are actually correlated. He has been extensively published and cited in the top finance journals and featured in over 600 media outlets, including Bloomberg, the Journal, New York Times, and Financial Times. He's also served on the faculty at Arizona State, Yale, Hong Kong University of Science and Technology, and at HBS. So we'll have a Q&A period after John's discussion. If you have questions along the way, please do submit them via the chat, and we'll curate them in order, more or less. Please note whether you are comfortable being called on to ask your question in your designation personally. Generally speaking, if you give your question to the overall group, I'll presume that I can call on you to ask you to give it. If you give it to me privately, then I can curate it that way as being private. So we'll try to do that whenever possible. So without further ado, Michael, let's hand it over to you. The floor is yours.
Thanks, Chris. Can you see my screen okay there?
Yeah, it looks great.
Okay, good. All right, so I also want to thank Craig and Lauren, as well as Chris, for organizing the webinar and inviting me to participate. I'll reserve thanks for my discussant, John, until after his discussion, but I do look forward to it. Let's dive into this. Okay. So CLOs are popular and getting more so, even after some rather large hiccups like the Great Recession and the onset of the COVID crisis. In aggregate, CLOs are approximately equal to the size of all private ABS markets combined. They've funded about 2/3 of all leveraged loans since 2009, and they're an important asset class for banks, insurers, pension funds, as well as other investors, including some hedge funds. So as a result, CLOs have received a lot of attention from lawmakers, regulators, and the financial press, though I would argue a lot of this attention is due to scars from 2008 and conflation with other three-letter abbreviations. So, as Chris mentioned, we're going to ask two questions in this study. First, what market imperfections do CLOs address? More simply, what's the point? What's their role in the economy? And second, how large are the costs of these imperfections that they're designed to address? And we're going to answer these questions by examining CLO performance using a novel and comprehensive database that merges in-tech CLO data with market loan pricing data. This data is going to allow us to study the near universe of CLOs, and in particular, the performance of both assets and the entire liability stack. So in doing so, what we're really doing is complementing a growing literature that's explored the implications of CLOs for a variety of different economic outcomes, including the cost of capital, bank lending, systemic risk, and in the case of my discussant, John, credit ratings. Okay. So let me try and summarize our key findings and then our economic messages before diving into some of the details. So our key findings are threefold. One, CLO equity generates significantly positive risk-adjusted returns, alpha, if you want to call it. On a before fee basis, you can think of a CLO equity investment as generating a profitability index of about $1.70. That is, for each dollar of equity capital you put in, it spits back $1.70 in present value terms. This scales up to around $35 million per deal, of which managers are capturing a significant share through fees as well as their holdings. A closer look is going to reveal that this outperformance is concentrated among CLO 1.0 deals. That is, deals that took place before 2009. Interestingly, it was the 2005 to 2007 vintages, just before the onset of the Great Recession, that exhibited the best performance. Two, CLO collateral performance is on average equivalent to loan mutual fund performance on an after-fee basis, and equivalent to a leveraged loan index on a performance on a before fee basis. And then finally, CLO debt is actually quite interesting. It's relatively expensive on a systematic risk-adjusted basis, though I have to admit that that result is a little bit fragile, but there. But CLO debt offers high yields compared to similarly rated swapped corporate bonds. And so what are the takeaways, at least the economic messages of the paper? So in terms of which frictions they're trying to address, first, CLOs help mitigate the effects of capital requirements on banks. Specifically, they provide for high-yielding, safe assets that relax balance sheet constraints while appealing to banks' incentives to reach for yield within ratings categories. Independent of regulation, CLOs cater to the demand for safe assets, which itself is predicated on the inability of economic agents to costlessly transform cash flows for consumption purposes. So take your pick in terms of violations of Ricardian equivalence. Now, the usual frictions motivating pooling and tranching, namely transaction costs and information asymmetry, are unlikely first-order considerations in this space, right? But pooling of leveraged loans is not unique to CLOs. There are, of course, loan mutual funds. Further, CLOs are economically and legally not securitizers because they are obtaining credits into the collateral pool as opposed to retaining them as an originator might. Mitigating inefficiencies in the leveraged loan market, sort of taking advantage of mispriced loans, is also actually an unlikely rationale for CLOs. On average, CLO collateral performance is no better than that of a loan mutual fund or passive fund, depending on net or gross of fees, though there is quite a bit of heterogeneity across CLO managers in terms of their performance. And so CLOs are generating surplus that's largely captured by equity holders, which interestingly is in quite stark contrast to what we thought happened with CDX equity after the Koval-Jurek-Stafford paper, after having seen what Pierre and Francis did in their subsequent follow-up work. Okay, so let's take a look, an unadulterated look at the data, if you will. All right. So let me give you a glimpse into our sample. We've got about just under 2,300 deals, the majority of which are in the CLO 2.0 timeframe, that is post-2009. We see the big hiccup associated with the Great Recession here and the overall growth in the market. The average deal size is about $500 million, and there's not a ton of variation around that number, surprisingly, though there are some outlier deals. Okay. If we think about the leverage or over-collateralization of these deals, they've actually been becoming less levered over time, starting from a high of around 92% down to just under 90% these days. And a nice visual to illustrate this over-collateralization is in the following figure. It bifurcates the sample into CLO 1.0 early deals, CLO 2.0 late deals. And you can see two things to come out of the transition across the deal structures. First, the equity share has increased. So that's the red portion of the bar here. That's consistent with the declining leverage ratio. But the other interesting dynamic that you see is an increasing subordination with deals over time. In other words, right, the fraction of the liability structure insulating the AAA tranche has grown significantly. And that's due in part to two forces. First, there's a pull force on the demand side of the market asking for greater subordination to support the AAA tranche. But there's also pressure from the rating agencies who are demanding CLO managers increase their level of subordination to justify a AAA rating. Now, in terms of completed deals, which is what we're going to have to focus on to measure most of the performance, though we'll look at other measures of performance for non-completed deals on the back end. We've got about 770 completed deals with some natural censoring down here. Obviously, later deals have yet to complete. Okay? And so if you look at our results on completed deals, it's really sort of pre-2015 deals that it's capturing most of the performance of. Obviously, how that evolves over the next few years will be interesting, and we'll incorporate as data becomes available. All right, so let's dive into some performance measures here, starting with CLO equity at the bottom of the capital stack. The first measure I'm going to show you here in the table is internal rate of return, just a yield. Okay. I'll show it to you in terms of net of fee performance and then gross of fee performance. The average net of fee performance has been around 10% over the sample, but it's clear that this overall average is hiding a great deal of temporal variation that I mentioned earlier or alluded to earlier, right? Most of the performance action is coming from the early part of the sample, CLO 1.0, and that holds on both the before and after fee basis. The next metric we wanted to look at trying to address risk is something called the public market equivalent, or PME. And you can think of PMEs quite simply. This comes from Kaplan and Schwartz, their, I think, 2005 JF paper. You can think of these measures as profitability indices. They're computed by discounting the cash flow distributions by the realized rate of return on some underlying benchmark. In this case, I'm using the S&P 500. And then we scale by the size of the investment. Right? So figures for PME greater than 1 correspond to outperformance relative to the benchmark. Figures less than 1 correspond to underperformance relative to the benchmark. And of course, that takes a very strong stance in terms of a risk adjustment standpoint on what the benchmark is and what the actual factor or risk exposure to that benchmark is. But again, let's start here with our first risk adjustment. And what you see is something very similar to what we saw with the internal rates of return. We see quite a bit of outperformance in CLO 1.0 relative to 2.0, and on average, outperformance relative to the whole market. Now, that's a little bit of an apples to oranges comparison in large part because if you think about the beta on CLO equity, it is probably not 1, okay? And so our first step in sort of moving closer towards a more sensible risk adjustment is, one, we're going to take a look at changing the benchmark from just the overall stock market to bank stocks. Because if you think about a CLO, at least the way I like to think about it in my simple mind, is that it's really just kind of a bank, right? It's funding financial assets with a whole bunch of leverage. Now, obviously, the leverage is different in terms of duration, demand deposit versus 7-8 year debt. And the asset portfolio is much more diversified in a bank relative to just leverage loans in a CLO. But I think the analogy is useful for illustrative purposes. So when we compare performance of CLO equity to that of bank equity, you see the outperformance really skyrocket in CLO 1.0, and that's not surprising. Banks did sorry, we're being recorded. Banks did poorly, right, in the shadow or the aftermath of the Great Recession. So I'm discounting by a very small number here. You get very large NPVs. That's all that's going on there. Okay. So, a very simple look at CLO equity performance, it seems like CLO 1.0 has done quite well relative to most benchmarks. CLO 2.0 somewhat less well. And there's quite a large difference on a net versus a gross fee basis. Now, let's turn to the asset side of the CLO and look at collateral performance. And I'm talking about the entire collateral pool, that is the pool of leveraged loans. I'm going to use 2 benchmarks to compare performance against, collateral performance against. The first is the LSTA Leveraged Loan 100 Index, and this will be on a gross of fee basis. And you can see that the PMEs are very close to 1, where 1 is just sort of fair performance or no abnormal performance. If I compare on a net of fee basis to the performance of loan mutual funds, who actually have somewhat similar fees in aggregate, again, the PMEs are very close to 1. And if you wonder, well, how good are these benchmarks for CLOs? They're actually quite good because CLOs, based on their indentures, are required to hold diversified portfolios of leveraged loans, both in terms of industry as well as concentration in any individual lender. So they really are just holding diversified portfolios of loans, and that shows up very clearly in these performance measures. They perform like a diversified index of leveraged loans, okay? So not terribly surprising there. So now let's turn to the last piece of the balance sheet, which is the debt. Okay. And I'm going to look at debt by credit rating, CLO debt by credit rating. I'll show you yields. I'll show you average public market equivalents, where the public market equivalents are based on similarly rated swapped corporate debt. right? So the CLO debt is floating. Corporate debt is fixed. So to get a duration match, we wanted to swap the corporate debt to have a similar duration to that of the CLO debt, hence the swapping. And so what do we see? We actually see some slight outperformance relative to similarly rated debt, okay? And I want to emphasize, thus far I've been talking in terms of outperformance, underperformance relative to some benchmark. I have not been talking about outperformance in a risk-adjusted sense, because there are clearly risk differences across CLO debt and even swapped corporate bonds of similar ratings, right? CLO debt is less liquid. CLO debt is subject to higher prepayment risk. CLO debt arguably has greater systematic risk, which is what we learned from the Koval et al. Paper. And I think we have to be careful. We can extend that sort of caution to the previous results on CLO equity as well, insofar as public equity markets, namely the full stock market or bank stocks, aren't exact matches in terms of the systematic risk profile. All right. So to address these shortcomings, what we want to do is we want to try and provide a more flexible risk adjustment to benchmark the performance of CLO equity, CLO debt, and collateral. And there's a really nice paper by Arthur Korteweg and Stefan Nagel that came out, I think, 2016 in the JF, that develops a framework called a generalized public market equivalent that allows us to utilize arbitrary linear factor models to construct a stochastic discount factor that we can then use to discount the cash flows. I'm not relegated to using realized returns for some benchmark or test portfolio. Rather, I can use some linear combination of factors with arbitrary risk exposures to perform the risk adjustment. Now, of course, that's subject to concerns about model misspecification, but that applies to all of asset pricing. So we're sort of in good company in some sense, depending upon your perspective. And what's really interesting here is that, using a CAPM as a simple benchmark, if we look at GPME estimates of the performance of CLO equity, you can add 1 to these numbers to compare them to the previous numbers I showed you. We still see significant outperformance on a risk-adjusted basis as opposed to some static benchmark. Now, if the market value balance sheet's going to hold, we know return on assets has to equal weighted average of the return on equity and debt. And so if there's outperformance over here in equity, something's got to give on the collateral or debt side. And so when we take this to collateral and debt, you can see that the debt is underperforming on a risk-adjusted basis. Now, I have to confess, these results, the debt ones, are a little bit more fragile in terms of, well, statistical significance, they're okay. But in terms of sensitivity to model specification, that is what factor structure we apply to the SDF. But it's comforting to see that what's going on here is that the debt is expensive in a risk-adjusted sense relative to the equity. So there's sort of a transfer between debt and equity, whereas the collateral is fairly priced. Okay, so how do we interpret this? Okay. So going back to the motivation, is this transaction costs? No, again, I mentioned the fact that CLOs pool leveraged loans. That's not unique to CLOs. If I want exposure to leveraged loans, I can just go invest in a loan mutual fund. There's no additional benefit to the simple pooling, though there may be some sort of second order benefit. Okay. Is this information asymmetry? When we think about securitization, right, and pooling and tranching, specifically on the tranching side, what we're really thinking about is mitigating the adverse selection problem. If I'm a bank originating a loan that I want to get off my balance sheet and I want to sell to someone, well, the investor rationally assumes that I'm selling them a lemon. They'll discount that, and that reduces the cash flow to the originating bank. So securitization is a way to mitigate that problem by pooling and then tranching out the risk appropriately. But that's not what's going on here, because CLO managers are not originating these loans. Okay, they're participating or purchasing in them in the secondary market. And this is exactly why the risk retention rule was overthrown in 2008. Managers are not deemed securitizers. They don't arrange the loans. Is it inefficiencies? No, I showed you that the collateral pool on average performs no different than a passive index in leveraged loans or a loan mutual fund. So it's not that CLOs are skilled in aggregate at picking off cheap loans. Some managers, yes. Other managers, no. On average, there's no skill there on that dimension. Right? Really, what's going on here is these are arbitrage vehicles between the leveraged loan market and safe assets. Okay, you've got cheap loans relative to expensive CLO debt that equity is arbitraging. And we're seeing, moving from CLO 1.0 to CLO 2.0, we're seeing that arbitrage shrink over time. The performance is declining along any measure. And so the sort of interesting feature of CLO equity, though not specifically unique to CLO equity, is that CLO equity in some sense is augmenting the span of tradable claims, right? Think about a hedge fund that holds equity. It's typically funded by short-term debt, exposing them to rollover risk. CLO equity has term leverage. It's locked in at a fixed spread over 7 to 8 years, depending upon the maturity of the CLO. So you have this long-term closed-end structure that facilitates equity performance and provides a certain degree of resilience to the security. And so I want to kind of highlight that resilience by doing a simple comparison. Lauren, I hope I'm doing okay on time here. If not, just shake your head wildly. Okay, that's good. So I want to compare the performance of CLOs around the Great Recession, 2008, with their performance around the onset of the COVID crisis. Now, we only have data going up through December, well, now March of 2020. I'll show you through December of 2020 and talk about what's been happening. We just haven't integrated the most recent data. What this picture shows you is it shows you from December 2007 to June of 2010, the median market value coverage of the debt. In other words, if I look at the market value of the asset pool and take that value and divide it by the value of the CLO debt tranche, what number do I get? If it's 1, right, I've got just enough debt to cover that. I've got just enough value in the asset pool to cover the value of the debt on the liability side of the CLO. And you can see that collateralization rates were up around 1, above 1, with the exception of the lower rated tranches. Okay. It collapsed after the fall of Lehman, so that even AAA tranches were actually significantly under collateralized, around 90% of asset value for each dollar of AAA debt, but then swung out of it over the next 9 months to what the pre-crisis, approximately what the pre-crisis level were. So the Great Recession really ate into market values of collateral. Compare that to what happened with COVID. We see running up in COVID, there's 2 things to note in this picture relative to the Great Recession. First, collateral rates were significantly higher across the entire secured note stack. Even the lowest rated tranche B was up above 100%. When COVID hit, the single and double B tranches dropped to be under collateralized right here, but triple B and above was still all over at or over collateralized. So in other words, the market drop, the market value decline with the onset of COVID was relatively modest compared to what happened in the Great Recession. This quickly rebounded about a quarter later to the point where now all of the tranches, or at least I should say careful, the median tranche is now again over collateralized. If we look at what happened to equity payouts, you can see that in the Great Recession, so that the x-axis is the same here, the annualized equity payout, think of this as a dividend yield. That's the easiest way to think about it. The annualized dividend yield collapsed to 0 for the median equity tranche in the aftermath of the Great Recession before rocketing back up quite quickly. Whereas in light of COVID, there was barely a blip. Okay. Now we have to be careful here because these are median or averages. There's dispersion here. Some equity holders got completely shut out of distributions in the COVID crisis, but on average, there was a very modest decline in distributions to equity holders. Okay. So what are we seeing here? What's interesting is we're seeing these enormous economic shocks and quite a bit of resilience. So let me try and wrap up a little bit early to afford my discussant more time to give us feedback as well as any comments from the audience. So, going back to where we began, what's the point of these things, which is really kind of the question I had. Well, the point is to mitigate several imperfections that are imposing significant economic costs that are captured by equity holders. The costs, of course, I laid out earlier. And what's interesting as we look forward, there's an enormous amount of uncertainty. And those that do, and those that can't teach. So let me tell you what's happening without actually putting my money where my mouth is. This is a little snapshot from a recent chart from S&P showing what happened in the crisis. We see a sharp decline in deal flow in Q1 2020, but look what's happened as of Q1 2021. Deal flow has just skyrocketed, in large part because of refinancings that have been happening, but as well as some new deals as well. We're also seeing potentially the creation of a multi-dealer platform by Citi and B of A, which has the potential to really accelerate growth in this market. And so, in a nutshell, CLOs seem to keep plodding along. They've had an awful lot thrown at them over the last 15, 20 years, but they seem to keep coming back and back and back, which isn't to say there isn't risk. That's not the message of this paper. But from a performance standpoint, they've done pretty well initially. They're coming closer to market over the recent term. So let me just close with that and thank you for your time.
Great, Michael, thanks so much. And now we're going to turn to our discussant, John Griffin. John, you're muted. It's okay. This is the first time I ever use Zoom as well.
Yeah, it's taken a while to travel here. So can everyone see my slides okay? So good. It's a pleasure to discuss this paper, and this topic of structured finance is one that I've been working on for a while, and it is one that has attracted quite a bit of attention from the media and so forth. And like Michael said, I think the importance of rigorous research in this area is very useful. So as Michael noted, I just wanted to highlight that there is brisk CLO issuance. Of course, it basically went away during the financial crisis for a couple of years, but it slowly creeped back afterwards. And as Michael noted, that in 2020, we also had a fairly big rebound in the second part of the year. And if we just look at the structured finance space in general, we see that this area of CLO debt plays a large role. Now, those numbers pre-crisis also include CDOs, which is an unfair comparison here to the pure leveraged loan market that the authors are examining. So in terms of how to think about this market and why we're interested in it, really, I would say that this paper holds a unique place in terms of the first academic study to comprehensively examine CLO returns. And so I think that is its contribution. I think it's an important contribution and probably the reason why it won the prize. I think there are several interesting questions to examine. In particular, what are the returns, which the authors do a careful job of addressing? How do you compare these relative to other alternatives, and why do the returns exist? And I guess my discussion is going to focus on the last part of that, and I do take a different twist to this and a different interpretation of this evidence than the authors. Maybe I should have read the opinion piece. I wasn't aware of the opinion piece, but as you will see, my opinion piece would differ substantially from that. But at the same token, my opinion piece might differ substantially from the authors, but at the same token, I don't quibble really with the authors' results or what they've done, nor do I think it contradicts or that they can rule out an alternative explanation. So maybe we'll have some discussion about that. So first of all, let me point out the strengths of the paper. As I mentioned, it's an under-researched area. It has incredible data, particularly the Intech data, but also combo with the market. We look at CLO equity returns. We've got careful benchmarkings. We have a public equivalent. The authors use asset pricing models to try to control for some of the other things that the benchmarks don't. They look at this on in terms of a fee and net of fee basis. And one of the things that I think they was highlighted more by Michael, but probably could be a little bit more highlighted in the paper, was just this difference in CLO 1.0 versus 2.0 performance, and why there is such a big difference, because there is a very important difference in the returns through time, and that does tell us some things about the market. And then the other aspect of this is the CLO debt returns. And I think it's extremely interesting, just the large amount of returns that's earned here for the AAA tranche, for instance, 70 basis points, but all the way down to the BB tranche, 1.7%. And those returns, if you compare those returns relative to pre-crisis returns, and I think Michael alludes to this as well, that these returns are actually quite considerably larger than the returns pre-crisis, suggesting that maybe investors did learn something out of the last crisis, although that doesn't tell us the fact that these are earning a yield premium. We have to be careful in terms of, is this return enough? Is this extra yield enough, extra return and yield enough to compensate for the extra risk? And I don't think we have a good answer for that. Overall, the paper is quite thorough and careful, and I'm not going to really quibble about the details of things. I could quibble about a few things, but I'm going to focus more on the big picture here. Some minor suggestions, though. I did notice in the previous version of the paper that the authors talked about cross-sectional performance differences across managers. I found that pretty interesting, and they allude to the analysis here, but they don't really show the analysis, and maybe they're going to do that in a follow-up paper. But I think there are some pretty different, pretty interesting things one could learn in terms of, is there differences in skill, or is it just risk tolerance, and how do investors price those differences? How much are investors aware of those differences across managers? Maybe that's a subsequent paper. And then the other thing is just in terms of what can we learn from the time series of the yields? Right at the end, Michael was showing some interesting results about that from the recent crisis. And I think one limitation of learning from the time series in terms of yields and prices is just limitation of the data and the size of the shock that we got in March 2000 and the length of that shock. So how to think about this market? Well, here's one interpretation of this market, is that risky loans, they come together and they get securitized. Rating agencies, because they have conflicts of interest and are too optimistic in their ratings, they tend to overrate these securities. And there is also the factor, which the authors note, that these rating agencies ignore the catastrophe bond nature of debt, in the sense that these bonds are systematic and their risk is going to cluster in these bad states of the world. There's also substantial evidence that insurance and pension funds, they reach for yield, and that in the process of reaching for yield, they might overpay for risky collateral. In particular, they might overpay for AAA, AA collateral And you could have a similar for banks in terms of regulatory arbitrage, that banks need these AAA, AA assets on their balance sheet. So economists like Michael might call this a market that mitigates market imperfections. And I think a lot of economists would talk about the market that way. But if you talked about a market where assets were misrated, which is what happened in the last financial crisis, where assets were misrated and AAA bonds weren't in fact AAA, other people might call this a market that exploits regulatory requirements and informational asymmetries among investors. So that's an alternative interpretation of this. So let me just kind of run through. If you had such a market that it would lead to possible market distortions, and that would be the possible market distortions that could arise from this market would be excess returns for the CLO equity investors potentially, or excess returns for the CLO equity managers or rangers. Now, there's several reasons to think you might not get that, because it is a competitive market. There's a lot of capital moving into this market. And so I think, consistent with at least the CLO 2.0 results, the author's evidence really speaks to that it doesn't seem like there's great returns in the 2.0 space, at least. In the 1.0 space, I would argue that it is very hard to measure risk. The authors do a nice job of that, but you have these issues being securitized in 2007, and then all of a sudden you're coming out of the financial crisis, and it's kind of tautological that they would earn extreme returns. So the lower yields, what would this lead to? If it doesn't lead to the first two things, it could also lead to one of the latter two things: lower yields on CLO tranches than actual risk. Now, the authors do show very interesting evidence that there is higher yields than equivalently rated corporate debt. So it does indicate that investors realize that a AAA rated CLO tranche is different from a AAA rating on Johnson & Johnson, for instance. However, it doesn't speak to whether that rating is correct, or if that yield is appropriate or not. 70 basis points may be too high, or it may not be near high enough. So the lower yields, the other thing that could arise from this type of world is lower yields and excess risky lending in the leveraged loan space. In other words, if you have these assets that there's tremendous demand for tremendous demand coming from the pension fund and insurance space to exploit these market imperfections or information asymmetries, however you want to call it, then it could lead to a lot of excess lending in that space, and those loans essentially being underpriced relative to their risk. Now, let's talk a little bit about the structured finance space. The key features of structured finance. I applaud the authors. They have a nice long time series here, but we have to think about what a structured finance vehicle is to start with. And the key features are of any structured finance product is you got asset quality, the true quality of the underlying collateral, and then you have the correlation of the underlying assets. And then what happens with a CLO, of course, is that the arrangers model these features out, and they model these based to determine the allocation of the tranches. They then take their models to the rating agencies, and they determine the ratings and the risk, and et cetera. Now, the thing to note is that all of these features depend on what the default world state is going to look like, and the probability of that default and the state of default. But the stress test in which all these models and all these and everything is priced based on is actually not very often observed. We had a nice stress test in the financial crisis, but I'm going to argue that unfortunately or fortunately, depending on how you look at it, for a researcher, it's probably unfortunate. For those investors, it's probably fortunate that there was not a great stress test in this crisis. And that was because of the extraordinary actions of the Fed, and also the just the government spending in general, that we really didn't get a stress test this time. So I want to say that empirically, there's very little evidence that the problems from the last crisis that existed in structured finance were fixed. Now, I have a survey paper that surveys the last financial crisis and all the academic literature, and there was a tremendous consensus among many academics that there was a real problem in structured finance, and that structured finance did two things. It created AAA rated assets that weren't really AAA. When they blew up, they caused tremendous harm to the financial system. And secondly, in the process of creating those AAA rated instruments, they funneled a lot of capital to an area where it wasn't needed, housing, and that caused a housing price bubble and collapse. So that evidence comes from a variety of papers, including my own, but many academics. And I would say that there's nothing that precludes that possibility of happening in the CLO space here recently, even, except for the fact we could have, as empiricists, we could have been observing the same thing, and then we would be talking about why this happened and so forth. But instead, what we didn't get that kind of shock to the system. So just because we didn't observe that kind of shock doesn't mean we're not going to observe that kind of shock in the future. We did have the beginnings of such a shock, but we never got our stress test. So we only really had one stress test to test these assets. And so I think that, in terms of the opinion piece, which I haven't read, and I would like to read it, but I would differ with the conclusions of that. So in summary, the topic is very important. It's got great data. I think the authors do a careful job, and it's a very interesting question, and it's important. I think the results are meaningful. I don't want to take away from that. It's just, I do quibble with some of the smaller takeaways and what the implications from this is. And I hope investors, I personally wouldn't take away from this paper that structured finance, or particularly the CLO market, is performing a great function and helping society in a meaningful way, without further stress tests to analyze whether it's functioning properly. So that's I look forward to discussing these issues. Thanks.
John, thanks again for your discussion. Michael, we'll kick it to you, obviously, for your reaction, and then we'll open it up for questions.
Yeah, I think I can now safely say thank you. John, thanks so much for the thoughtful comments. You're partly to blame for this paper, because it was, 12 years ago that you got me interested in this space. It did take me 12 years to write the paper, but a big thank you to you for the thoughtful comments. They're greatly appreciated. Is it okay if I maybe just say a little bit, Chris?
Yeah, please do. Yeah.
I actually think our takeaways aren't too dissimilar, John. What I'm referring to is more, regulation. When you talk about regulatory arbitrage and regulation, well, that only exists because there's some sort of externality sitting around that the government thinks it's fixing, right? And so at some level, I think we're a little bit closer than you think on the takeaways. But what you've revealed is we've done a really poor job of writing it. And so I think that's really helpful for us to think about. Another thing I wanted to note is I think it's important to emphasize that structured finance is not equivalent to CLOs. Yes, CLOs are, in a broad sense, structured product, but not all structured products are alike, right? So if we go back to the stress test of 2008, as you call it, right? AAA CDOs lost, I'm trying to think, about $325 billion. That was the disaster that you're talking about. AAA CLOs lost nothing, not a penny. And I'll explain why later if people are interested. So there's a very big difference between the CLOs and the CDOs in terms of their performance through the Great Recession. Number two, CLOs nonetheless responded because we saw a decrease in leverage and an increase in subordination. So there was some response to that despite no loss up at the top of the stack. And so, going forward, I agree with you. I mean, there will be future stress tests. How they'll perform, I have no idea. But the last few stress tests, even though varying in degree, they've gone through quite well.
Yeah, I think I agree with you, Michael, that you do caveat some of these things in the paper, and so I'm not. I should be clear that it should be clear that I think you understand some of these limitations. I do understand the very CDOs of mortgage-backed securities were essentially a CDO squared, essentially, right? And then there were CDO squareds on top of CDO squared. So those were levered bets, and they're very different from the CLOs. CLOs did have a great experience in the last crisis. They came out fairly well, but like you noted, there was substantial uncertainty in terms of how they would perform, and the prices of the instruments were down below par value. So investors were at least anticipating that there was a possibility they could be, even the AAA tranches could be wiped out, which, if you think about what a AAA asset is, you should, according to the rating agency methodology and how these things are modeled, that should never occur it should only occur about once every 725 years. So we do have a paper with Jordan Nickerson in 2017. And there we tried to model out, is the correlation assumption appropriate in CLO space? And what we found is that the rating agencies did up the CLO correlation assumptions coming out of the last crisis, and they upped it substantially, but not as much as the models that account for correlated defaults, like the Duffy et al. Type models. So that if we have such a big shock where everything falls out, that these CLOs are not priced appropriately for that kind of shock. So yeah, I agree that performance has been great in this space, and I think that's what attracts people to it. But ultimately, yeah, it'll be interesting when we finally see the stress test.
Hopefully not.
Yeah.
At what cost? A data point. Good. Thanks, guys, for a really a constructive discussion. I think we'd like to go to questions now. And Leon, you asked Leon Tadavassian. I'm going to go to you first. And you asked a pretty early question, and it was shaded and articulated by both Michael and John. But I think your question still is a good one. Would you like to voice it? Did we lose Leon? Well, maybe he got the answer and that was it. Okay. Leon's question was about performance and the cost structure that you alluded to, but to a higher cost structure of highly rated classes in 2.0. Did you want to comment on underlying costs and maybe efficiencies or lack thereof?
Yeah, I can. Let me provide a little texture to the differential performance across CLO 1.0, 2.0 for the equity tranche. So the reason the 2005 to 2007 vintages performed so well is ex post, is because think about the dynamics of spreads over the pre, during, and post-crisis period. So 2005 to 2007, spreads were relatively small. They were able to get relatively low cost funding for the structure to then purchase assets. Then we move into the crisis, spreads blow out. There's a ton of refinancing and turnover in the collateral pool of CLOs. So CLO managers are swapping into, not swapping in a contract sense, but buying into, exchanging, trading into credits with much higher spreads, But remember, on the liability side, they're locked in at the pre-crisis tight spreads. So coming out of the crisis, what they've done is they've turned their asset portfolio over from low spread to high spread while retaining the low spread funding, right? It's long-term closed-end funding. And the result was this windfall of cash in 2010, 11, and 12 for the equity holders. That's what happened.
Got it. Okay, so there are a couple of related performance-related questions that I'm going to pool. One that Vladimir just put into the chat box, and another that was private, that was communicated here. But also, Feng Zhu asked a question. Why don't we go first to Vladimir, and then we'll go to Feng Zhu. And Vlad, you put yours right in the box, but why don't you go ahead and articulate it, and then Feng will go to you. Or maybe I'll just go, Vlad, I'll go ahead and ask it then. The question is, what, do you have insights about the underlying fundamentals about why they perform so well? And then Fang's question is, how can managers take 47% of performance?
Okay,
Yeah.
so two questions there. I mean, ex post, I think you can look back and say it was part skill, part luck, right? You know, again, I actually think I'm quite close to John in his perspective. Look, the stress test of 2008, they got lucky that they were able to come out of that without a complete collapse of the liability structure, right? They recovered, okay? And so the performance was luck in the sense that spreads blew out without the entire asset pool defaulting and leaving nothing for equity. Right, that's what happened in 2008. So on the upswing, on the recovery, they had enough value in the asset pool to get excess spread down to the equity tranche. Now, I say that's part luck and it's part skill because the managers are actively trading, right? So that's why I think they did so well coming out of the Great Recession. Now, how are managers able to take such a large share? Well, the fee structure is really large. First, there's a fixed senior fee, then there's a subordinated fee, then there's an incentive fee, and then there are back-end rebates. And I have to be very careful because we don't have data on the back-end rebates. That's not part of the trust of the indenture. So we only see all the other fees. So they're collecting a lot in fees. And then second, quite a few CLO managers will actually hold the equity tranche. So they're participating in the upside as well as receiving the fees. That's where the large fraction of surplus is going.
Yeah, I think knowing some of the folks who are on the call, I think we have folks who are active in this space, but they may not want to comment on that on the rebates. Although if someone wants to jump in right now, of course we're happy to hear your perspective. Yeah, I don't see anyone jumping on, but I know there are folks, a handful of folks who are in this market. Good. Here's a private question that's not unrelated. Does the paper address what the Fed did to support, with all their programs to support credit markets? Are you controlling for it? And the thought here was that the Fed was unable to support CMOs. So looking at those vehicles might also be interesting by contrast.
Yeah, I think that's an interesting comparison. It's unfortunately one we didn't undertake simply because it's beyond the scope of this paper, just like John's suggestion on looking at heterogeneity in manager performance, which I think is not just interesting, but important. We were a little worried that we would bite off more than we could chew well in one paper. That's the only reason we didn't go deeper. Yeah, understood. And you know, we have a limited budget for data. No, bring it on. We're happy to support it. A couple related questions to that one. Let's go to this one from Prakash. Prakash, do you want to articulate your question about normalization?
Sure, thanks. So I was just curious. This is a great paper, by the way. I loved it. Just wondering, how do we look for different macroeconomic variables, because the world pre-2008 was very different post-2008, and in the current market with the pandemic, all these spreads are converging. Like there is not a whole lot of differentiation between high yield and investment grade. So in those situations, how does a CLO based on levered loans fare, and how do we then kind of normalize and say that this is the spread over a particular base asset class?
Yeah, so I'd be curious to hear what John has to say, but really briefly, I mean, that's a big concern, Prakash, this sort of non-stationarity of the economy. Now, we've seen that in our results in that CLO 1.0 and CLO 2.0 are experiencing very different return profiles. And just a month ago, I was reading about a spread on a junk bond at, I think, 2%, which I think set an all-time record. So what are we seeing, both with collapsing spreads and low interest rates? What we've been seeing is we've been seeing a lot of interest rate floors on CLO debt tranches and correspondingly on the leverage loans in the asset pool. So that's been one mechanism to deal with sort of the insurance side of things. But in terms of the collapsing spread, it's sort of limiting the room to play. But I've talked enough. I'm kind of curious to get John's take on this. John?
Good. Yeah, John. John, you're muted again.
Well, there was a related question in the chat. I don't know if we're going to handle it, but about the what are the differences between the mortgage-backed security crisis and the market being very levered. I don't know if you're going to go over that one, but
yeah, you can interleave it right now. That's
okay.
We're going to go there. Yeah, sure.
I mean, basically, the question says, well, you know, the market was very levered in terms of, as we alluded to previously, it had this inherent leverage with the CDOs that were built over the leftover parts of the mortgage-backed securities, and then CDO squareds that securitize the leftover parts here. So there's less inherent leverage. The question is, isn't there less inherent leverage in the structure? And that is right. But the question then also says that many of these things have been regulated away. And that's a broader question, but my understanding of it is that many things haven't been levered away. I mean, we have more strict leverage. We have more strict leverage requirements, but there's still the possibility to have too much leverage in the financial system, or to have a misfiring of leverage. And in these securities, there is still credit default swaps being used in various forms, although not the direct CDO squareds, but yeah, there's still a lot of leverage in the system. So I don't think it precludes that type of financial crisis. But I can't.
Chris, you're muted. Or
No, there's, like I said, this is the first time I've ever used Zoom, so that is really funny. And it was really an intelligent way of linking these questions. The remaining questions have kind of a principal component, which John, you just tilted into, which in a sense is about concentration and about productization. Mark asks about CLO ETFs and how they compare to closed-end funds. June Fan, our friend June, who's often at our events, asks, is CLO concentrated in a few sectors or region? And then Sharon Lee posted a comment, which John, I think you addressed in part around leverage, but also the remaining notion of democratization of exposures and the creation of products for retail investors. Can both of you comment on these ideas? Again, concentration, sectors, regions, ETFs and closed-end funds, and how do you think about those and how do they compare? And then finally, it's a good way, I think, to wrap it up. Are we productizing, or is the industry productizing this for retail investors in a way that you're concerned about personally? Let's go to Michael, and then we'll ask John.
I was hoping you'd go to John, then me. But okay, fair enough, Chris. So my 2 cents. So in terms of CLO concentration in sectors and regionally, not so much sector, because they are required to hold less than 10% concentration in any sector. So these are relatively diversified portfolios of loans.
And Michael, this is in the covenants, right? It's not necessarily
This is in the indenture.
Investment Company Act 3.5.10 rules or something. It's,
no. These are in what you call the covenants. Yes, absolutely.
Yeah.
So you're restricted to concentration in a sector. You're restricted in concentration in an individual borrower. But there is certainly concentration geographically. CLOs are predominantly a US and then UK phenomenon. And that's more or less it. And what's been interesting to see is there's been growing interest in other parts of Western Europe for exposure to CLO, either equity or debt tranches, that I've seen only anecdotally. The second part was retail exposure. So yeah, I've noticed some CLO ETFs, both on the AAA side, so for sort of liquidity storage purposes. I don't know if there are CLO exposure to CLO equity. Maybe John knows that. But the CLO ETFs, AAA tranche is running at about 25 bips. I actually find that quite attractive. Let me say that cautiously. I'm not giving it investment advice here, and believe me, I'm the last person to ever do that. But I find it attractive in terms of offering retail investors exposure to safe floating rate instruments at not too excessive a cost. 25 bips isn't horrible. Yeah.
Okay, thanks, Michael. And John, what's your view?
Yeah, that was I mostly agree with Michael's comments on that. I think there was at least back when I was back last year, there was at least three funds that you could buy to get exposure to CLO equity, and although unfortunately or fortunately they were heavily shorted, and so it was I got squeezed out of my short position on one of those, but
it wasn't connected to Reddit at all, was it? I mean, no, that's a data point.
This was all pre Reddit, and I never have used Reddit on the forum. But related to the question about retail, I don't really think that that's a problem in this space. Retail investors getting too much exposure. Those funds were fairly small. I could not be aware of some. I could definitely not be aware of some avenues. But in general, the rise of the retail investor and their movement towards certain spaces, I do find that, particularly like the SPAC area recently, I think that there is some potential for .com type future repercussions. What happened after the .com? We look back after the .com bubble and we see that, a lot of resources were academic papers show that a lot of resources were funneled to firms that didn't have much viability and didn't create much economic value. It led to destruction of some economic resources, and so also misallocation of resources and fraud. Which is often, this is my interest or examination, oftentimes in the aftermath of these bubbles. So I think we'll look back upon the SPAC bubble and likely see similar features to the .com bubble, and wonder what people were thinking at the time. But there may be other retail spaces that are overheated, but that's the one that catches my attention now.
And not so much democratization in this market. Okay, folks, that's all we have time for today. Thank you all for attending, and a special thanks to our presenter and our discussant, Michael Roberts and John Griffin. Thank you so much, gentlemen. If you'd like further information on the paper or the Jacobs Levy Center, please do continue to visit our website. That's Jacobs Levy Center, all one word, .wharton.upenn.edu. With that, folks, I'd like to wish you a good day, and also thanks to Lauren Hurry and Mike Walsh, and also my co-director, Craig McKinley. Continue to stay tuned, folks. We're leaning into the year of the vaccine, so hopefully we'll get a chance to see you in person. Again, thanks, everybody. Cheers.
Thank you.
Thank you, Michael. Thank you, John.
Thank you, everybody.
Cheers, bye.